Well, let's just talk about it. This is a third consecutive improvement in the retailer confidence index. We're looking quite good right now.
That's quite right. In the middle of 2011, that index level was at 50, which means that half of the retailers were satisfied with prevailing conditions. That increased to 56 in the fourth quarter of 2011, and we've now finally registered a 61, which is the first time since, or the second time since 2007, that 60% of retailers indicated that they are satisfied with prevailing business conditions.
One of the things that seemed to feed into this level of confidence seemed to be the employment numbers that we got at the end of 2011. Just talk to us about going forward, where we could see momentum coming from.
There's no doubt that the non-durable and especially the semi-durable retail sectors benefited from that 370,000 jobs that we saw being created in the latter part of 2011. That job growth, if it's sustainable in the short and medium term, will bode well for both those two sectors going forward.
One of the things that was in the report, though, was when it comes to those non-durable goods, we are seeing some kind of a downward trend. You know, would that be because people are not replacing as much, or could it be that, you know, people are probably in a tougher financial situation than they were, you know, say end of 2011?
I think you've alluded to the two factors driving it. It would appear on the back of 10% increase in volumes in 2011 and 5% in the year before that some of the household appliances, furniture and electronic good retailers are facing the end of a replacement cycle. In 2011, that was supported by a low interest rate environment as well as some aggressive discounting, but they've showed or demonstrated a marked decline in volume growth in the first quarter of 2012.
Well, let's just talk about some of the pressures that are on the consumer right now. We have seen this huge petrol price increase. We've got e-tolls that are probably going to come in now, and the consumer probably is thinking, well, maybe I shouldn't be spending so much. Do you think that we could see that filter through into the confidence of retailers at your next index?
I think if one considers the disposable income of any consumer, that's certainly become under pressure, especially the discretionary portion of that. You've alluded to increases in fuel prices. There are definitely soaring increases in food prices. There are some other administered tariff increases which will all take away an element of discretionary spending of an amount of money, which means that the margins of particularly the non-durable retailers are going to be under some pressure.
One of the things that we have seen, I mean, you were talking about how this report is this retail report correlates with the business confidence report, you know, where we did see just pretty much every sector actually doing much better when it came to this index. But one of the things that we have seen, particularly say with manufacturers, for instance, and just if we were to take a specific business in that, let's talk about builders, where they're saying that the margin pressure is huge, whereas with retailers, particularly in clothes, it was almost the opposite.
It would appear as if the retailers in the footwear and clothing sector was able to pass on a significant amount of costs. So impacting on their cost push was some high cotton prices in 2011, a weakening exchange rate, and they were selling into resilient consumer demand, which I'm interpreting that they had the value proposition as far as attracting a larger slice of that discretionary income absolutely right. Builders are definitely suffering. They are still in the middle of a phase that hasn't yet worked up the same amount of momentum.
When we're talking about, particularly with the clothing industry, and we're talking about that resilient consumer, how much longer will the consumer be resilient?
One of the questions that we do ask the respondents to clarify is to look one quarter ahead. And whilst they have indicated that they expect their volume growth to moderate, they are still pretty bullish as far as volume growth is concerned. So at this particular point in time, I think they are still backing the fact that they have a decent value proposition that will continue to attract more consumers or a larger share of the same consumer's disposable income.
Let's talk about semi-durables and looking forward and what retailers are saying could happen to that particular portion of their business.
So the semi-durables is the clothing and footwear that you've alluded to. They are by and large far more bullish relative to the non-durable and the durable retailers. And I think they really rate their chances of continuing building on the sustainable base of volume growth that they have experienced.
Okay, let's talk a little bit about what's happening globally, and we have seen this, you know, where we are getting some good data. We're not where we should be. If we just look at the whole year of 2012? Do you think that we could continue to see this kind of positive data coming in, seeing an uptick, or maybe could we stay at these levels?
There's no doubt that some of the troublesome matters overhanging the European financial crisis is to some degree providing a basis to project forward. I think what the consumer and what the economy needs is more consistent, positive data points. So instead of it becoming a volatile story of 1 week we feel good and 1 week we feel bad, if we can build on a lot of momentum, I suspect that we'll get to that tipping point where that will become a reality later in the year.
One of the things that we do see when it comes to the MPC, one of the things that filters into their decision is what's happening in the global economy, what's happening with the rand, and where inflation could be going. What is your outlook on that?
I think at this point in time, the MPC must be interested in the fact that South Africa is more competitive externally due to a weakening exchange rate since the same period last year. I suspect that from an interest rate outlook perspective, it would be particularly brave and possibly a little bit early to start tweaking those interest rates up. I think they need the economy to gather some momentum, and then I think they will more seriously look ahead to see how they should effectively manage that.
Because when it comes to those interest rates, that also filtered through to the retailer having more disposable income to be able to spend.
A low interest rate environment with also an outlook of it not substantially changing in the short term provides the consumer with a little bit more certainty. They can plan better, which gives them more confidence, and that confidence ultimately manifests when we ask the retailers the kind of questions we do.
What are the retailers concerned about going forward?
I think retailers at this particular point in time are still having to manage increases in input prices, and some of the categories of retailers are better at passing that on. They have the luxury of selling into a resilient consumer, which are prepared to pick up some of those increased selling prices. But at this particular point in time, more and more of those costs are being trapped in the income statement of those retailers, which mean that the turnover line goes up, but there's no volume growth. It's only price. And of course, that has an impact on decreased margins.
Thank you so much for joining us,
Thank you.
David. Derek, I was talking to Xavier just early on. Thank you so much for joining us, Derek.